Hello, class, and welcome to our sixth lecture series on managerial accounting. And I'm your instructor, Jamal Haider. So, today we are starting a new chapter named the cost volume profit relationship. We also call this CVP analysis. I already sent this picture in our WeChat group, and I also going to be going to upload on Blackboard as well. Here we go. So the basic introduction of this chapter is that how changes in cost, changes in the volume affect our profit, or what are the relationships among changing different costs with the volume and with the profit as well, right? So there are numerous applications of this CVP analysis. So we will be seeing one by one. So our first learning objective is, excuse me, any question? Okay. So our first learning objective is explain how changes in activity affect contribution margin and net operating income. So we are hearing a new terminology, that is contribution margin. We have heard in our accounting gross profit, net profit, right? Operating profit. What is this contribution margin or contribution profit or contribution margin, right? So this is the new terminology. Let's explore this. So the basics of the CVP analysis starts from the contribution margin, which is a contribution margin is the amount remaining from sales revenue after variable expenses have been deducted. So simple. Sales minus variable cost is your contribution margin, right? So the contribution margin income statement is helpful to managers. Remember, this is for the managerial purposes, right? So contribution margin income statement, which is written here like sales minus variable cost minus fixed cost, you see net operating income, right? Oops, sorry. We are having a little bit problem here. Yes, fixed. Yes, it is. Okay. So the contribution margin income statement is for the managers, not for the public, because they need to make some decisions regarding how much sales price we need to change, how much we should change the cost, and how much in volume we need to sell, right? So all the emphasis depends on the cost behavior, right? So you see here, now another definition of our cost volume profit analysis. Number one, contribution margin is used first to cover the fixed cost or fixed expense, and then any remaining contribution margin contributes to net operating income. right? Oops, what's going on? There we go. So if you see here, the contribution margin in income statement, sales less variable expenses is the contribution margin. So another definition of contribution margin is that after covering fixed cost, if you see the fixed cost is 80,000, so after covering fixed cost, whatever left will directly go to operating income. So remember, here we are talking about operating income, not the net income, right? So here we go. If our fixed cost is 80,000 and our contribution margin is 100,000, so on the top of our fixed cost, 20,000 will directly go to operating income, right? So the other definition, sales minus variable cost is the contribution margin. The other definition that we just talked about is contribution to the margin. After covering fixed cost, right, whatever left will directly go to operating income. So there are a numerous of application of this concept. Let's talk about one by one. So we know that we have learned the contribution margin format, how the income statement is created from contribution margin. Sales minus variable cost is equal to contribution margin, and then fixed cost, we have net operating income. So remember, this is not the net income, this is net operating income, which means still there need to be taxes that need to be deducted from the operating income. Also the interest expenses, not interest expenses, taxes is not to be deducted here. So net income also include the effect of taxes, but operating income do not include here the effect of taxes here. And now, sales, variable expenses, and contribution margin can also be expressed on per unit basis. So we just saw that total sales minus total variable cost is total contribution margin. We can also express the contribution margin in terms of units. So where this 500 came from? We have 500 bikes, sales are 250,000. So 250,000 divided by 500, answer is 500. So per unit sale price 500, and then we have 300, which is the variable cost. And how we calculated that? So variable cost, it is 150,000 divided by number of units 500, answer is 300. So in that case, the variable cost is, what's going on here? Guys, are you seeing this zoom and zoom in, zoom out?
Yes.
Okay, wait a second. I need to pause the recording here. Okay, guys, we have to resolve our issue. Okay, so we can also express the contribution margin in per unit form. We just discussed that where this 500 came from. We have 250,000 sales divided by the units 500. And where this 300 came from? 150,000 is the total variable cost divided by the quantity 500. Right? So 500 is the price minus the variable cost per unit 300. So this 200 is also our contribution margin per unit. So give me the answer that why we are not calculating fixed cost per unit. Why we just stick to this per unit contribution margin. We have calculated the per unit variable cost, right? But we are not calculating the fixed cost per unit. The answer is because the behavior of fixed cost is that it behaves the same with the level of output increase or decrease. So in total, whether you produce 500 bicycles or 1,000 or 10,000, fixed cost remains the same. But when converted to fixed cost per unit, then the behavior of fixed cost changes. Per unit behavior is not constant, right? What if right now this is 80,000, so 80,000 divided by 500, answer is 160, right? 80,000 divided by 500, 160. Using 500. What if we produce 1,000? Answer would be 80, right? So the behavior of fixed cost is not constant in per unit. Okay. Similarly, the behavior of variable cost, when we see in total, it's variable. If we produce, so our per unit cost is 300, but if we produce 600, the cost is going to be 180,000. So you see, in total, the behavior of variable cost is not constant, it's changing. So that's why its name is variable cost. But in per unit scenario, it behaves in a constant fashion. Only 300, right? So the per unit analysis or the per unit behavior is, we can trust on variable cost, but we cannot trust on fixed cost. Whereas in total scenario, we can trust on fixed expenses because it remains fixed. Irrespective of how much we produce, it remains the same. So we can trust total fixed cost, total fixed expenses, and we can trust per unit variable cost because these are not changing, right? So that's why here we did not consider per unit fixed cost.